Is there any way to avoid paying taxes on your Social Security benefits? There actually is. I'm going to share 4 different strategies with you. Social Security was once tax-free. In 1984, it became taxable for people whose income was above a certain level. Those levels haven't been updated for years. So people with income as little as $25,000, which includes half of your Social Security benefit, have to pay federal income taxes on part of their Social Security benefits. Boo! About 40% of people who get Social Security have to pay federal income tax on part of their Social Security benefits. This happens when you have other income in addition to Social Security. This income could be from wages, self-employment, interest, dividends, and other taxable income that has to be reported on your tax returns, like distributions from pre-tax retirement accounts. If you're an individual filer with a combined income between $25,000 and $34,000, or married filing jointly with a combined income between $32,000 and $44,000, up to half of your Social Security benefit will be taxable as income. If you're single and your income is above $34,000, or married filing jointly and your income is above $44,000, up to 85% of your Social Security benefits may be taxable as income. Come on!
What?
People who keep working after starting Social Security, even part-time, are more likely to have to pay taxes on their benefits. People who have income from 401ks and IRAs often do too. It's possible to avoid paying income taxes on your Social Security benefits, but it's not easy. It requires some careful planning and strategies. The secret is to reduce your adjusted gross income. This prevents your provisional income from triggering a tax on Social Security. So here are 4 different options to reduce your adjusted gross income to get into that tax-free zone. I know there are some other strategies, but these are just the ones that I've researched. Strategy number 1, and my personal favorite, convert to a Roth IRA. Withdrawals from Roth IRAs or 401ks are not subject to taxes. This is because taxes were taken out when the contributions were made. If your money's in a pre-tax IRA or 401k, you already had the tax advantage. You got an income tax deduction when you deposited the money. Income from a Roth account doesn't count toward the income that will affect taxes on your Social Security. You do have to have a Roth account open for over 5 years and be 59 and a half before you can take withdrawals tax-free. You can open a Roth account at any time, and you can continue to contribute during retirement as long as you have some earned income. Be aware that converting from a pre-tax account like an IRA to a Roth account means you'll have to pay taxes on that money. This can be substantial. But after that first tax bill, distributions will be tax-free from then on. They also won't count towards your income calculation. If you retire early, you might consider converting some of your pre-tax accounts to Roth accounts. You want to do this before you start taking Social Security and after you stop working full-time while your income is lower. This is my plan. If I retire at 58 and a half and take Social Security at age 62, that will give me 3 years to convert some of my pre-tax accounts to Roth accounts. Strategy number 2. On the flip side, one strategy that may appeal to some people is to reduce or eliminate interest and dividend income. You can convert reportable investment income to tax-deferred income. One option is an annuity, which won't show up on your taxes until you start taking distributions. Just for an example, if you have $100,000 in a CD earning 5%, that'll earn you $5,000 per year. That $5,000 will be counted as provisional income. But if that same $100,000 was growing inside an annuity, with the interest reinvested back into the annuity, it would yield a reportable income of 0 when calculating provisional income. Annuities do generally become taxable when you start taking distributions. If you're not spending all the interest paid from a CD or other taxable account, you could benefit from moving at least some assets into a tax-deferred account. Just be sure to do a lot of research if you choose an annuity. They are not all created equal. Strategy number 3 is to minimize withdrawals from your retirement plans. Money that you pull from your traditional IRA or 401k will count as income in the year that you withdrew it. That will increase your adjusted gross income. If you can minimize these withdrawals or even not make any withdrawals at all, it will help you get close to that tax-free threshold. Of course, this may not be possible if you're forced to take the required minimum distributions. That could just push you over the edge. You also may just need that money to live on. I have a video about using health savings account as a retirement account that have no required minimum distributions. I'll link that in the description below in case you're interested. Strategy number 4 is to make sure you're taking your maximum capital loss. If you're invested in stocks and bonds and have a loss on paper, you might want to sell and realize that loss so you can claim it as a deduction. This is called tax loss harvesting. It can give you a decent deduction from your income. The tax code allows you to write off up to $3,000 each year in investment losses. A write-off first reduces any other capital gains you've earned throughout that year. For example, if you have a $5,000 gain on one asset but an $8,000 loss on another, you can claim a deduction for the full $3,000 net loss. Any net loss beyond that $3,000 has to be carried forward to the next year. Even if you can't realize the full value of that net loss, it can still make sense to realize some loss, especially if it pushes your Social Security into the tax-free zone. Tax loss harvesting works only with taxable accounts, not tax-deferred accounts like IRAs and 401ks. If you decide to use tax loss harvesting, you might want to consult a tax professional. If you do have to pay taxes on your Social Security benefits, you can choose to have taxes withheld to avoid or reduce owing taxes in the future. At the end of each year, the Social Security Administration will send you a benefit statement. It will show what you received during that year. You can use this to figure out how much of your benefit is taxable and what you might do to minimize taxes for the following year. While the idea of tax-free Social Security is very enticing, and many people do avoid paying taxes on their Social Security benefits, the cost may be having an income that's minimal. You can make financial moves that maximize your after-tax income, but don't make minimizing taxes your only goal. If you earn no income, you pay no taxes. But earning no income isn't necessarily a sustainable way to live. If you could make some reasonable changes to how you receive income, then aiming for tax-free Social Security could make sense. But for many people, this would require a massive overhaul of their lifestyle. It also simply may be impossible given your income and assets. If you're interested in Social Security tips or lowering your income taxes, check out my playlists. I have a playlist of Social Security tips and one about income taxes that I'll link in the description below in case you're interested. If you're new to my channel, hi, I'm Julie and this channel's Happy on Monday. Thanks for joining me. If you found this helpful, please like, and if you're interested in early retirement, consider subscribing to my channel. Today I'm going to leave you with a quote by Plato. The greatest wealth is to live content with little. Hope to see you again soon.